We're moving on to learning objective 4, and we're going to start to put these T account concepts into practice and begin to analyze some transactions and figure out what all of this debit and credit stuff actually looks like. So when you're confronted with a transaction, the first thing you want to say to yourself is, okay, what happened here? What did this company do? Did they buy something? Did they sell something? Did they incur an expense? What exactly happened in this transaction? And so once you're clear in your own mind what happened, you then start to say, okay, what accounts were impacted by this transaction? And we must always have at least two. You might even have more than that, but you will have no less than two transactions that are two accounts, that are impacted by every transaction. So now that you've decided, okay, I know what happened and I know what accounts were impacted by these transactions, now you need to say to yourself, okay, within each of the accounts that were they impacted with the balance going up, or were they impacted with the balance going down? And so once you've decided, okay, our revenue went up, so our revenue balance went up. Now you may want to refer back to that handy little chart I told you to commit to memory or set aside someplace handy, because now that you know what happened, you know the account, and you know whether or not the balance went up or down, you now need to figure out, well, does a credit or a debit in that kind of account result when the balance goes up or down? And that's kind of the nuts and bolts, and hopefully you'll start to see this as we put it in practice. So we've got Mitchell Williams. He's the owner, and this is going to be a brand new company that Mitchell is starting. And he is going to invest $5,000 in this business to start off. So we now need to just step back and think about the framework. Okay, we've got somebody that is putting money into our business, and we have two accounts that are going to be impacted by that. Our cash account, because the company's now going to have cash as a result of Mitchell's investment, and Mitchell is going to have a balance. He's going to have equity in the company. So Mitchell's capital account is going to go up as a result of this transaction. So in terms of thinking about these accounts and where they fall on the balance sheet equation, cash is an asset, capital is in the equity, I remember under that equity umbrella. And so now, and again, if you have to go back to that chart, that's totally okay. You need to decide, okay, when cash goes up, is that a debit or a credit? You also need to ask yourself that about your capital. When our capital account goes up, is that a debit or a credit? And so hopefully you remember from the video that or the little chart I had you clip out, a debit to cash will result in the cash account balance going up. A credit to Mitchell Williams Capital will result in his capital account going up. And we're going to look at this a second in T account format, not in words, and it may make hopefully a little bit more sense. Okay, sorry, a little phone call got me sidetracked here, but back to T accounts. So what we see from the transaction with Mitchell and his company is that Mitchell's capital went up by the $5,000 investment. You'll notice that little plus sign on the credit side, but the company also has $5,000 in cash that it didn't have before. So its cash went up. So that lands on the debit side. Now let's look at what Mitch does next. He bought a motor scooter, which we will categorize as delivery equipment, for $2,000 in cash. So again, thinking through what happened here. He bought his motor scooter and had to use something to buy it with, and the answer is cash. And he now has delivery equipment that he didn't have a minute ago. So those will be the two accounts that will be impacted. Now, before I click forward, I want you to start thinking to yourself, okay, how were these two accounts impacted by this transaction? Do we have more cash or less cash as a result of this purchase? Hopefully, you come to the conclusion that we have less cash because we spent $2,000. Now, how about our delivery equipment? Do we have more or less? Well, we didn't have scooters before, we have scooters now. Now let's look at how these are impacted. So both cash and delivery equipment are assets. And so in this case, and I'll go over to the T accounts in a minute so you'll see the balance sheet equation. Both of these entries are going to be made within the asset side of the balance sheet equation. And it will be a debit to delivery equipment because the balance in our delivery equipment went up, and it will be a credit to cash because the balance went down. And so I'm just going to hop over because this is something that I haven't really, I think, addressed at all in this video yet. Remember here we've got assets equal liabilities plus owner's equity. Let's go back to after our first transaction, we had assets totaling $5,000, and then we had 0 in liabilities, and our owner's equity was $5,000. So our our balance sheet equation was true. Assets equal liabilities plus owner's equity. And so now moving on to this, we've added yet another transaction. And so what we have here is our cash, which did have a balance of $5,000 after the initial investment. We've now credited the $2,000 cash as a result of buying the scooters. And so our balance in the cash account is now $3,000. Looking at our delivery equipment, we debited because we now have our balance went up in our delivery equipment account as a result of the value of these scooters. And if we total up our only two, I would say all our assets accounts, but there's only two of them. We have cash with a $3,000 debit balance and delivery equipment with a $2,000 debit balance. So overall, our asset picture hasn't changed. It's just shifted forms. And our accounting equation, our balance sheet equation, remains true. So now Mitch, I guess we're now getting casual here. We're no longer Mitchell. He bought a second motor scooter, this time on account. And I want to highlight that because in the prior example, he bought the delivery equipment for cash. So what's the difference, you say? And the difference is that he did not use cash in this transaction. On account means he didn't pay for it. We still owe it. And if we still owe it, then it's going to be, we're going to have a liability. So what accounts were impacted? Well, we've got more delivery equipment again, but this time we owe some money. So we've got an accounts payable. So remember in the last transaction, we had cash, but this time we have accounts payable because we didn't actually pay for them yet. Our delivery equipment is an asset account. Our accounts payable is a liability account. It's a debt that we owe. So we're going to debit the delivery equipment once again to account for the new scooter, and it's a credit to accounts payable for $1,800. And if I haven't said it again, or said it before, I will say it now. When you do a transaction, the total of the debits and the total of the credits must equal. If your total debits and total credits on each transaction don't equal, you are out of balance and you cannot proceed. Your balance sheet equation will not be true. So let's look at this delivery equipment situation. So we've got the new scooter here, and that has increased the balance in our delivery equipment account by another $1,800. So we have now $3,800 in delivery equipment. Our cash hasn't changed because we haven't actually paid for these things yet. So we have total assets of $6,800. Now, moseying on over to the other side of the equal sign, we now have a liability. We have a debt we didn't have before. And so the balance on what we owe people has gone up. And when that happens, it's a credit. And we haven't touched our owner's equity. But if we perform the balance sheet equation and we add our liabilities and our owner's equity together, we come up with $6,800, which lo and behold matches what's in our assets. They are equal, we are in balance, we can move forward. Next transaction. So Mitch made the first payment on the scooter. Okay, so this is where things become a little bit more challenging. What accounts are affected? Well, what did he make the payment on? On the debt for the scooter. So we had that accounts payable. What did he pay it with? Money, his cash. So even though it doesn't come right out and tell you, those are the kind of the lines you got to read between. So we've got cash and accounts payable that were impacted by this transaction. Now you've got to start to ask yourself, okay, well, how did it affect these accounts? Did their balances go up or down as a result of these transactions? Well, if we used some of our cash to pay the debt, we probably have less cash, right? Right. And if we paid down some of the debt, then we probably owe less money, right? Right. So what we have are decreases in the balance, of those two accounts. And so remember, cash being an asset, accounts payable being a liability. If you need to refer back to that little chart to see when we decrease the balance, whether that lands on the credit or debit side, feel free to do that, but we're going to just forge ahead and say that the cash asset, again, is decreased, and the liability, the amount we owe, is also, we owe less as a result of having made the payment. So we're going to credit cash and debit the accounts payable for $600. And I'm going to jump over to the T accounts so that you can see that. Here we are over at the T accounts, and now we see a credit. We have $600 less cash than we did before this transaction. So our cash went down by $600. This makes our total cash $2,400. Now we haven't touched our delivery equipment yet, or at all, because we're not addressing the equipment itself. All we're addressing is the debt on the equipment. So we leave the equipment alone when we go to pay the loan on it. So we come over here to our debt for the delivery equipment, our liability, and we see again the minus sign. We're going to reduce the balance on our liability, and that means that we now only owe $1,200 on that scooter. And owner's equity remains the same. So $5,000 plus $1,200 gives us $6,200 on the right side of the equal sign. And on the left side with the assets, lo and behold, again, we didn't touch the equipment as a result of just making the payment. We addressed the equipment when we initially bought it, but now we're going to leave it alone when we pay the bill. All right. So finally, Mitch is going to make some money. So he made some deliveries and received $2,100 in cash from his clients. Well, okay. They give us part of it. So we've got $2,100 in cash that we didn't have before. So that's pretty easy. Cash was affected. Mitch made deliveries. Now, it may not be totally obvious from the example, but Mitch is in the business of making deliveries. And so Mitch's company has now earned some money as a result of having performed this service. And what we call that is, in this example, delivery fees. You can call it revenue, income, however you want to name it is perfectly fine. There's not a, it's this, the name delivery fees is not a rigid account title that must show up in every delivery company. So companies have some flexibility in the terminology that they use when they name these. So we've got cash and we have delivery fees. Our cash, again, is an asset. Delivery fees falls under the revenue side of things. And so our cash is an asset. Cash went up and we earned money. The balance in what we have recorded for revenue went up as well. So what causes those things to go up? A debit on the cash and a credit on delivery fees. And let's look at that in T account form. Here we are under, and I won't take my umbrella out, but under the owner's equity, if you recall, the delivery fees live under this umbrella. And revenue lives under this umbrella, and delivery fees is a revenue account. And when we earn money, that's a credit. Now, that money that we've earned came to us in the form of cash. And we now have cash that we didn't have a minute ago, which has raised our balance in the cash account. So now we still have our lonely old liability of $1,200 over here, but the owner's equity side gets a little more interesting finally. We still have our owner's original investment of $5,000, and we now have delivery fees, which makes our total under the owner's equity umbrella $7,100. Now, to make if we want to perform the balance sheet equation and we want to add our liabilities, that gets us to $8,300 on the right side of the equal sign, and on the left side of the equal sign is our assets, and they equal. We are in balance. We may move forward. Now we're going to pay our office rent for the month of June, $1,000. So we paid something. And that suggests that we used cash. And what is office rent? Sounds like something I pay here. It's an expense. It's something that costs me money to run my office so that I can earn money. So we've got cash. And under the expenses, we'll have an individual expense for each kind of expense. You'll have, phone expense. You might have just utilities. You could have cleaning expense. You could have all kinds of expenses to run a business. So you'll name those all in their own little individual accounts. And so in this case, we've got rent expense and then cash. So where do these live in the balance sheet equation? Again, cash is an asset. Rent expense is an expense. And what happened? So the cash went down because we paid out our rent. And what we've recorded in expenses for rent went up, our rent expense. So how are those impacted? Well, cash being an asset, and we know that credits make assets go down. It's a credit to cash. And then rent expense is a debit for $1,000. And we'll look at that umbrella of owner's equity to help kind of make that clear. So We've got our expenses under owner's equity. So now we've got rent expense, and that again changes the owner's equity picture. So as a result, so we've still got our balance of 5,000 for revenue or for capital, our revenue of 2,100, but now we've spent some of that revenue, making our owner's equity 6,100. We still owe money on that scooter. And so when we perform the balance sheet equation and we add that to the owner's equity, that gives us 7,300 on the right side of the equal sign. Now, if we mosey on over to the left side of the equal sign, we look at the credit to cash as a result of having spent that money and the reduction in our cash balance. We've still got our delivery equipment. So $7,300 are our assets, and lo and behold, they equal our liabilities plus our equity. And this video has gotten extraordinarily long, so I'm actually going to stop here and go on to the next video for transaction G.